Okay, I've got just about 2 minutes after the hour. Let's jump right in. This is the third quarter 2021 version of the Beacon Point Macro and Markets Update. I'm the Chief Investment Officer of Beacon Point, Michael Dow. We've got a pretty packed agenda, but before we get started, a couple of a pitch to listen to some of the other ways we can communicate with our friends in the industry, clients, and prospects. You can keep in touch through a couple of great podcasts. Kobe Kress and Karen Reifel run a podcast called Dollars and Cents with really good, relatable financial info. Mine are Markets in Motion. I try to do them about every 3 or 4 weeks, and it will be primarily on topics that we'll address today, macro and markets. About a 15-minute podcast for me. Tonight or today and this afternoon, this morning, wherever you are, wherever you're joining from, is a review of our investment themes, both our secular and our cyclical investment themes. And the topic today is going to be inflation. The good news is the economy is continuing to reopen. So we can take the mask off Lincoln, but we may have to put it back on him depending on how the Delta variant shakes out. So we're a couple of functional notifications here. If you need to use the speaker view, go right ahead. It's in the upper right-hand corner. You can see the screen and my face. None of the other folks are on the screen right now, so everyone else is hidden. And this is an opportunity to answer to your questions. So there's a Q&A here in the webinar. Use the chat, please, and we'll aggregate questions during the course of the webinar, and we'll answer them. So this is supposed to be interactive, not a lecture, more of a discussion, and please know that's what we're aiming for. So the agenda today, similar to past market updates, is we'll revisit beginning at the top of the hour here with a review of where we are in the financial repression theme. It's really important to get this one right. Investing is about catching the waves, and the longer term or secular wave that we think is going to likely drive investment returns and portfolio results is something we've termed financial repression. Our research team published a paper last July, so it's been a year now, and it's held up very well on this topic. And I'll go over the main points of it so that everyone is on the same page, and we're starting from the same exact point. Looking a little more closer to home, that is over the course of the next 3 to 4 quarters, our cyclical theme remains rates and rotation, but in the second quarter we added inflation in front of it. So IRR, inflation, rates, and rotation. We're going to spend a considerable time talking about inflation and the key points of the current burst or surge that we've seen in prices and how it will affect the investment landscape. The topic for today's quarterly review is peaks, and I've included a picture here of the Swiss Alps to sort of bring it home. We're seeing a lot of peaks, and they do have implications for our outlook. We're seeing peaks in policy stimulus, both fiscal and monetary policy stimulus, peaks in GDP here in the US and elsewhere, and peaks in corporate earnings growth rates. But we're not yet seeing a peak in COVID cases, given the explosion in the Delta variant. And finally, because what we need to do at the end of the day is manage the portfolios to achieve your investment objectives, we're going to tie it all together with some portfolio implications, and I'll identify risks to our outlook. So let's jump right in with a quick review of what's going on in terms of the global macro situation. This is data you've seen if you've tuned in the past. Using the JP Morgan global activity indicators, or the JP Morgan Purchasing Manager indices, the PMIs, is a good way to see in real time what the economic activity is like around the world. And you had, of course, this sudden stop in economic activity in the COVID recession, where these PMI numbers were reporting in the 20s. Anything over 50 indicates expansion, anything under 50 indicates contraction, and these were the lowest prints on record. But we had a V-shaped snapback recovery based on all of the stimulus, both fiscal and monetary, that we saw. And in fact, growth continued to expand into the second quarter. But in the first of one of the peaks that we'll take a look at, it appears that the momentum in global economic activity is starting to roll over. And again, one of the things you'll hear me say several times today as well, we're going to continue to see a positive print. That is, we're going to continue to be in expansion territory for some time. The growth rate of that expansion is likely to be fading. Another chart I like to start with is the PMIs that you saw in the prior, disaggregated into the individual countries. And it's just really a way to show that between February and June, most of the countries of the world were in contraction mode, not surprisingly. But fairly quickly, China got themselves out of it and have been posting pretty decent numbers since. Red means we're in contraction and green is expansion. Here in the US, it took us another couple of months to recover, but we're definitely on the right track here, and there's very sizable numbers. But I'll show you some other series which indicate that while the numbers remain green and positive and in expansion territory, the growth rate of those numbers is slowing. And here's part of the reason why we have a peak in some areas, but and one of the more important peaks that we just don't have any good information or intelligence on. We don't have an information advantage on how the COVID variants, including the Delta variant, are going to evolve. But we do know, as we see in the maps here, this was June 28th, by the way. June 28th, the number of COVID cases had taken a very positive turn due to some of the socially distanced things and vaccinations, which have slowed considerably. And when the vaccinations slowed and the Delta variant took off, this is what the map of the US looks like. Obviously, there's a lot more hotspots now, particularly in the Southeast, and some actually surprisingly in the Northwest, that than we saw in the prior just 6 or 8 weeks ago. So we're not through there's light at the end of the tunnel as it relates to COVID, because you've got 170 or 180 million people in the United States vaccinated, or at least have one vaccine, and 160 plus million that have been fully vaccinated. So there's reason for hope, but unfortunately, this is the number of new reported doses per day. It's only 700,000 now. This number used to be closer to 3 million, so we're down about 80%. But it is rising again with the increase in the COVID variant. So people are getting vaccinated, and vaccinations and other remediation is absolutely essential for the continued reopening of the economy, and continued reopening of the economy is essential for us to get everybody back to work. I won't belabor this chart. This is our forecast for the four main economic series that we take a look at during our quarterly macroeconomic meeting. Just to put a fine point on it, we are above consensus. We think the economy is going to grow faster, so our GDP print was above consensus. Also, we think and thought at the time that inflation was going to be above consensus, and that's something we've been working with as a working thesis for the last 6 or 9 months. Unemployment would dip below the consensus, and that the Fed would be on hold until at least the end of 2022. But then by the end of 22, given our more ambitious economic forecast, they would be likely to be ready to raise rates at that point. But let me take a step back. Again, it was about a year ago now where we first expressed the idea that over the coming quarters and probably years, we would be under a period and investing in a world of financial repression. And financial repression is simply official policies of the Treasury and the Federal Reserve that artificially lower a government's borrowing costs. When you're borrowing a limited amount of money, the interest rate that you're paying on that debt is less important. When the national debt is approaching 29 or 30 trillion dollars, or as a percentage of GDP, it's approaching 130 or 140%, then the interest rate that you're paying as that debt becomes due and rolls over becomes incredibly important. And in fact, this generally happens in emerging markets and higher yielding companies, corporate entities. You could get into what is called a debt spiral, where you're issuing debt to actually maintain debt sustainability and make debt service payments. And as interest rates rise, because they will as you take on more debt, your credit risk declines. things get out of hand. So if you're the government and you have the ability to influence your reinvestment rate, you're going to do so, and the Federal Reserve is the vehicle by which you will do that. So let me just talk a little bit about what the aftermath of the COVID recession has meant for our thesis related to financial repression. There's two types of stimulus being represented here. This is the fiscal stimulus aftermath, or the implications: higher deficits and debt. That's clear. If you're issuing debt, it means that you have a budget deficit, and if you're issuing more debt, then it means that the national debt is growing. Generally, that means you got to adjust from a fiscal perspective and raise taxes. We're going to talk a little bit about that in a second too. And the BIS and other entities, the Bank for International Settlements in Switzerland, and other economists and other folks have written papers, including Reinhardt and Rogoff, have suggested that if you have higher debt rates, then that will put a damper at some certain point, at some level, on your growth. And that makes sense. If you're making debt service payments, you can't invest in productive capacity. So higher debts and deficits are the reality, and I'll show you in the next slide where exactly we're at. But they do mean a couple of things: probably higher taxes, and certainly at some point lower growth rates. The other source of support for the economy in the last 15, 16 months has been quantitative easing in the Federal Reserve through money printing. And money printing does have, and quantitative easing has a very salutary effect. It lowers nominal interest rates, but on the flip side, it can generate higher inflation. That is, money supply. If you increase the money supply, the theory is, generally speaking, prices will rise. So there's an interaction here. You need lower nominal interest rates, but you're going to get higher nominal interest rates as inflation rises. So something needs to be done, and that something is financial repression. And financial repression lowers nominal interest rates. And unfortunately, when you have higher inflation and lower nominal interest rates, the result is negative real interest rates. This is terribly important. It's the cornerstone of our investment thesis, and drives many of the investment decisions that we're making on behalf of clients. Is this notion that we're likely to be in a low or a negative real interest rate situation for quite some time. So let me put a little bit of meat on the bones in terms of the backstory for financial repression and why it's absolutely necessary, and why I think it's the most likely, and we think it is the most likely path forward. What we're seeing here is on the left side is deficits, and over on the right is the national debt divided by gross domestic product, or our debt to GDP ratio, which is how we look at the level of debt. Last year, we printed a 16% budget deficit, and they're going to be budget deficits for as long as the eye can see. End of last year, we were about 120, 125% debt to GDP. We're going to 135, may go to 150%. We haven't seen that level of national debt as a percentage of our income or GDP since World War II. And the post-World War II period is very instructive, which we'll see in a moment. So huge debt levels, the ones we're seeing now, dampen growth, and they increase our risk to exogenous shocks. So really, it's an imperative for the policymakers in DC to reduce debt. And there's a pathway to doing so. Some of the paths are painful and steep and rocky, and the other paths, like financial repression, are a little more palatable. So just to put a quick fine point on why the government cares about it. If interest rates are low, you don't care about the level of your debt. But here's the sensitivity to increases in interest rates to how much the government is going to pay for the privilege of issuing national debt. For the last 50, 60, 70 years, about 1.7% of GDP has gone towards interest payments, and through a variety of different interest rate environments and with varying levels of debt. But given our current debt levels today, if interest rates just go up, call it 100 basis points or 1%, our current interest payments as a percentage of GDP will nearly double. And if they go up 150 or 200 basis points, if 10-year yields go from 1.25 back up to 3%, we'll be spending 3 times as much on debt service payments as we are now. And that will require much higher taxes or a substantial decrease in some sort of a discretionary expenditure. So the interest paid is very highly sensitive to nominal interest rates that are in the marketplace. because the government has to issue debt and has to roll over that debt at whatever the prevailing market rate is. So they have a strong interest in suppressing nominal interest rates, and we'll see that they have done so very effectively. So again, just to put a fine point on it, you can reduce government debt a couple of different ways. You can grow your way out of it. That's possible. Adjustment just means balancing the budget, raising taxes, lowering expenditure, not very politically palatable. Default is even less palatable. We've never done that here in the United States, with the exception of creating inflation, which is a form of default. And then there's deflation. And if you repress nominal interest rates through quantitative easing, that is, if you have the Federal Reserve buy all the net interest, all the debt that's being issued by the Treasury, that will collapse nominal interest rates. It will also create the environment for higher inflation. And those two things together will get you to negative real interest rates. So that's where we're headed. It's just really hard to balance the budget. This is a slide going back to the 60s showing that there's only been a handful of years where we've actually had a budget deficit. A budget surplus. Almost every year since 1962, with the exception of 4 or 5 years, we've had a budget deficit. And here's the latest data point. It's just really hard. It's really hard to manage to balance the budget, and as a result, you need to do other things. So I'm just going to leave this equation for reference and suggest that we're headed towards an extended period of low or negative real interest rates. And here's how it's calculated. Right now, the 10-year Treasury yields yielding about 1.35%. Inflation expectations that are built into the marketplace are about 2.35% for the next 5 to 10 years. And that leaves you with this 1% negative real yield. And the problem with negative real yields is that they are purchasing power destructive. That if you invested for 5 years at a negative 1% yield year on year for the next 5 years, you're just giving up 1% of purchasing power. So it's a significant challenge to investors when you're in this type of environment. And here's where we are in terms of negative real yields now, and going back 20 years. Real yields used to be closer to 3.5% back when Treasury inflation protected securities were first issued. The first coupon was 3.5 or 4% on tips. Now the real yield, as I've suggested, is closer to negative 1%. And it's gone down precipitously since the COVID recession. On average, real interest rates here in the United States for 10-year yields have been about 1% positive, but now they're 1% negative. So they're much lower. And just know this: if you are showing a significant negative real interest rate, real yield, and you've done so for a period of time, that just about convinces me that we are in a period of financial repression. The hallmark of financial repression is negative real interest rates. So just a quick scorecard to see how we're doing in pursuing, how the government is doing, how the Federal Reserve and the Treasury are doing in terms of pursuing financial repression policies. The first thing you do is take Fed funds, or the short interest rates, to zero. The second thing you do is cap nominal interest rates, and this is 230 years of Treasury market history. We are by far and away at the lowest levels we've ever been in our history. So nominal Treasury yields are capped. Short rates have been put at zero by the Fed. Nominal rates have been capped by quantitative easing. And then the Federal Reserve introduced a new framework for inflation, which is called average inflation targeting. And so now we see the highest levels of inflation since July of 1991. Average inflation targeting, I'll talk about because it's terribly important. It marks an absolute reversal of the way the Fed has thought about inflation for the last 40 years, which has been to fight inflation. Average inflation targeting is a way to fight deflation and to move average expected inflation or inflation expectations up from a level that the Fed would believe is uncomfortably low and try to get it back to 2%. What it means for the market is that inflation is going to, realized inflation is going to be allowed to run a little bit hotter than the Fed's 2% target for a period of time. We don't know for how long and for how high the Fed will start to react to inflation. But we do know it's very dovish from an inflation perspective. So you'll see higher inflation prints, and well, we've gotten that. Just to circle back to the post-World War II period, this is about 200 years of history looking at the 10-year Treasury yield. Here are the periods of negative real interest rates on 10-year Treasury. So the 1920s, the 1940s, and a little bit in the 1970s. And what happened to debt to GDP during that period of time. So you have very low real interest rates here from the period 1940 to 1970. And it was during this period, particularly in the immediate aftermath of World War II, where you had very deeply negative real interest rates that precipitated this significant and steady drop in debt to GDP. You saw on the earlier slide, we're about at 120, 130% debt to GDP now. This is the peak prior in the World War II period, 119% debt to GDP. So producing these negative real yields at the very front end caused this to reduce the debt to GDP ratio from very high levels to the 30% we saw in the 80s. We don't need to get back down to 30%. We are the reserve currency of the world. Part of the reason why we can issue so much debt and frankly print so much money is because we are the reserve currency, and we will maintain that status. The reason I show this chart is to suggest that we've been here before. The government knows how to do this. This is very well understood in the financial and academic literature, especially as it relates to the monetary policy literature. So it's going to happen. It is the way to do it. It's less painful than raising taxes, which is going to happen as well. But you need to balance the budget. You need to reduce debt, and financial repression is the way to go. So the question then becomes, what's the limit? What is the limit to the money printing and the debt issuance that we've seen that got us to the point where we need to repress financials? And the answer is the limit is our maintenance of U.S. dollar dominance as the unit of trade and effectively as the reserve currency. U.S. dollar dominates. There is no alternative to the reserve, to being the reigning reserve currency champion. Right now, 60% of all Forex reserves in central banks are denominated in US dollars. That's the key metric for determining who the reserve currency gets to be. If you're a central bank in some other part of the world and you're willing to denominate your assets in the US dollar, that makes the US dollar the reserve currency. The next closest challenger is the euro at 20%. The yen plus the pound is close to 11%. And the Chinese renminbi is just 2.3 or 2.4% of the total reserves out there. But it's grown, it's doubled, it's more than doubled, but it's going to be decades before China can challenge the United States dollar as the reserve currency of the world. And that is going to allow us to continue to issue debt when we need to, and to print money when we need to meet the objectives of the government to reduce public welfare losses by cutting off the fat tails of a depression, which is exactly what we did after the COVID recession. The government came out firing with both barrels, fiscal and monetary policy. We have the degrees of freedom to do so because we are the reserve currency, and we will remain the reserve currency for the foreseeable future. You can improve your chances of remaining the reserve currency, by the way, by reducing your debt load as quickly and as efficiently as possible. Hence, financial repression is the likely operating framework for the government and for investors for the coming quarters and maybe years. Just a quick turn to the legislative outlook. As everyone knows, probably the Senate passed the core infrastructure bill. It's not going to make it to the House for a couple of weeks, and it's going to have some trouble getting there, but it was passed. The bipartisan core infrastructure only bill was passed in the Senate. There's only a couple of ways to go. The original Biden proposal from April or May that made its way into the budget is a non-starter. I'll talk about probabilities on the next slide. But the most likely legislative option for infrastructure is either a compromise bipartisan bill, which again has made it through one half of the process in Congress, which is passage in the Senate, or just a reconciliation bill only, which seems unlikely to me because I think the bipartisan core infrastructure bill would be something that those that are going back to their home districts to campaign for the midterms would like to be able to say, yeah, we brought home some infrastructure spending, so you should reelect me. So it's all about being able to manage the politics here and understand the incentives of the participants to determine what actually is going to be implemented. And right now, I think the most likely case is some kind of a compromise bipartisan bill, which has core infrastructure, renewable energy, healthcare, education, and some family spending. That's gonna get all done. That's the combination of basically the reconciliation bill only and the bipartisan core. So the orange here is the combination of these two things. That's how you get to about $2.5 trillion and 1.5 of additional taxes. So we came up pretty strongly last April, May, when these original proposals for 3.5 trillion in new taxes were being made. So that's not going to happen. The constraints on being able to maneuver in Congress and get something legislated was going to keep that number way down. So where are we headed in terms of new taxes? This is our best guess right now. It's a binary decision. Things are moving quite quickly, and then they stop moving. So it's hard to say when we're going to know for sure. Probably by the end of the year. But in terms of what the tax situation would look like based on the legislative options we outlined on the prior page, you got the Biden proposal, which I think is only a 10% probability of being enacted. I never say zero. It could be zero. Could be 10%. It seems the lowest I would ever put on anything. Having only a reconciliation bill when you know that while they're not going to get everything they want because of the centrist Democrats in the Senate, you're going to get a reconciliation bill because after September 30th, when we get to the new fiscal year, you can do a budget resolution with a reconciliation bill in it. You can only do one a year. We did one already in March for the American Rescue Act. So you're going to get a reconciliation bill because the Democrats do have 50 votes in the Senate. They have a very slim 4 or 5 vote majority of the House, so they can get stuff done. But there are some Democrats that are not fully on board with the full-on progressive agenda, and as a result, you're not going to get the $3.5 or $4 trillion spending package with 3 trillion new taxes because there are some Democrats in the Senate, Joe Manchin, Murkowski, Susan Collins, and some others who will not support it. So knowing the state of play, knowing the incentives of the folks that are and where they're likely to vote and what they would support is really important in trying to decide where taxes are going to land. But I think it's going to be, you're going to have a pretty high personal income tax rate. The corporate tax rate's going up. This is the current policy over here on the far right. There is a probability you get no legislation whatsoever. It's a very low probability, as is the reconciliation only. But 60% likely you get a 25% corporate tax rate, just under 40% personal income tax rate. Capital gains go from 20 to 28, and you maybe have a modification of the step up in basis on the 1031, but they'll be retained. So that's the likely, that's what we think is going to happen. The taxes are going up, but they're not going to go up nearly as much as what was announced in the original proposal. Let's go to that's our secular theme. Our secular theme is likely to exert a pretty strong influence on how we look at markets and how we position portfolios in the longer run. In the intermediate term, we are focused on the cyclical theme of inflation, rates, and rotation. And that's where I want to spend the next 5 or 10 minutes. What's happened in rates? So interest rates, the 10-year Treasury yield, which was hovering around 2% 2 years ago and peaked at just under 2% as we headed into the teeth of the COVID recession, dropped 140 basis points in a flight to quality bid. So between December of 2019 and the end of March of 2020, the 10-year Treasury yield rallied to what was then the lowest level in history, which is just under or about 0.5% in yield. And it hovered there for a while. And then with all the stimulus that was coming on board, there was a lot of optimism. There was some hope that a vaccine would be produced. Certainly the stimulus was coming fast and furious. The Fed was doing what they needed to do. And the government was actually coming through and producing legislation that was going to help get us through the darkest times of the COVID recession. So by the time we got to the fall of last year, the reflation trade started to kick in, and then in the first quarter of last year, interest rates rose dramatically based on an estimate that the economy was going to continue to reopen unfettered. We were going to see maybe higher inflation. We didn't know then. We do know now. And interest rates peaked again at closer to 1.75%, so 1.75%. Since then, we've had a bit of a growth scare and interest rates have rallied. So what's happened to equities during this period, just as you'd suspect. But before we go there, just to put this interest rate increase into context, this is again that 230-year chart of 10-year Treasury yields. And the move from last August, so 1 year ago to today, which is up about 80 basis points in total. It was up 120. Now it's up 80. This move, this orange square here, which shows the Treasury move in the last 12 months, is this square when put into the context of 230 years of history. These are the same. These are the different scale, but same absolute movement. So the recent rise in interest rates just has to be noted. It's quite insignificant. And rates at 130 basis points are still very historically low. Why did rates go higher? The answer in the first quarter was because of fundamentals and supply concerns. So fundamentally, when inflation rises, and that's what you see here, this is inflation expectations. It's inflation expectations that matter when looking at the bond market. This is actually the realized inflation number, which is a lot higher than inflation expectations. That indicates maybe things are transitory. Maybe it won't. We'll talk about that in a minute. But in terms of supply, if you're issuing all this debt, that just means there's a lot more bonds that are in the marketplace, and with more supply, the price should be lower, and that means for bonds, if prices are lower, that the yield is higher. So there was trillions of dollars of issuance and expected issuance. So combination of higher expected inflation and the coming wave of Treasury supply caused interest rates to rise pretty dramatically during the course of the reflation trade in the first quarter. And rates and inflation to us means as interest rates rise, that the more cyclical areas of the market are likely to do better. So you should see a rotation from large caps to small caps. The blue here is the immediate performance in the aftermath of that's the first stage of the recovery. So between March and September of last year, so the immediate aftermath in the COVID recession, you saw large and small cap stocks both recover about 50%. But in the second stage, the rotation stage, which was November to March, so through the first quarter, small caps significantly outperformed large caps. And you saw the same phenomenon, value versus growth, although growth had such a great immediate, right out of the gate run, it was due for a breather. But in the period from November to the end of the first quarter, value significantly outperformed growth. So that's all rotation. That all makes sense to us. What didn't happen and hasn't happened yet is a rotation out of U.S. into international stocks. IFA did a little better than the S&P, or the the developed market stocks did a little better, but emerging markets continues to lag. So we saw the rotation out of value out of growth into value. We saw the rotation out of large and small, but not out of U.S. and international just yet. Why did rates go lower in the second quarter of this year? So over the last 4 months, all of or much of the increase in interest rates in the first quarter was reversed. Part of it was because of dealer positioning and a short covering rally. If everyone is on one side of a trade where they're thinking that interest rates are going to go up and they don't, then you have to buy treasury bonds to cover your short. And as a result, you have a short covering rally, which is what we saw. That's part of the answer. So part of it is technicals or positioning. Another reason was because inflation expectations peaked. So we've seen this chart before. This is just inflation expectations over the last 12 months. Inflation expectations averaged up about a little more than a half a basis point every day on average for about 7 months. But then all of a sudden, the change in inflation expectations was flat. And once it didn't look like inflation expectations were going to continue to rise because we have a bit of a growth scare, probably all related to the Delta variant and the uncertainty around the virus, inflation wasn't being priced any higher into the marketplace. And as a result, with bond positioning offsides and with inflation expectations coming down, it made sense that interest rates might rally a bit. And what happened in the equity markets? Just what we would expect. So here's the rotation performance we saw where large caps, this is November to March of 2021, and then the performance of these various sectors since April to today. So as interest rates were declining, this is interest rates going up, large cap underperforms small. So you have the rotation, small outperforms large as interest rates rise, value outperforms growth as interest rates rise. Not much to say about a rotation from US to international. You would expect, though, that large caps would outperform small caps as interest rates declined again, which they did. You would expect growth to outperform value, and they did. And you would expect the US to outperform the US, which it did. So the rotation trade is working as interest rates decline. It's working less for EM and developed market and non-developed market equities as interest rates decline. But I think that's partly because the rest of the world is just a little bit behind the US in terms of vaccination. So there's a little more certainty about making shifts in the US factors, small and large and value and growth, than there is yet a demand for non-US international, non-US dollar denominated stocks. So we expect to see that going forward, and I'll talk about that in a minute. Spend 5 minutes on inflation at least, because this is the most important topic. I was at PIMCO yesterday talking to some of the senior members of the investment committee there. And I just asked Scott Mathers, the gentleman that runs their total return fund, I said, what is the thing that the investment committee is worried about the most? And frankly, it was the same answer that we have within our investment committee, which is inflation transitory or is it persistent? And the problem there is if it's persistent, the Fed's going to have to act to remove monetary policy accommodation. If the Fed is going to remove monetary policy accommodation, then the stock market will not likely react positively to that. So it's really important to get this question right. If it's persistent, the Fed will have to act. If it's just a supply chain disruption or cost push type inflation, then it won't. So we've shown this chart a lot, which is the drivers of inflation and which are winning, I guess, in terms of which are outweighing one or the other. For the longest time, the teeter-totter was tilted the other way. The forces of disinflation were outweighing the forces of inflation. And the forces of inflation that we're all familiar with are quantitative easing or money printing, the Fed's new framework for average inflation targeting, which will allow inflation to run hot. Lately, we've had a bunch of supply chain disruptions, and with the recovery, the snapback recovery, the output gap or the slack in the economy has been declining rapidly. We're actually almost back to 2019 levels of nominal GDP. And the pullback in globalization and supply chains, which is also part of the COVID aftermath. We're finally and have finally outweighed or overwhelmed the forces of disinflation, which would include the debt overhang from the great financial crisis, an aging population, and the positive effects that come from productivity enhancements and technological disruption. So we've characterized some of these as being cost push, which are transitory. So some of these things are going to go away, and the Fed would be less worried about them, cost push. Demand pull, on the other hand, type of inflation drivers would be more persistent. So we're looking at inflation as either transitory or persistent on a number of factors, not least of which is, are they characterized as being a supply chain disruption or a demand disruption? And the other way to look at that is supply chain disruptions are cost push, whereas money printing is demand pull. That's more persistent. So let's talk about money printing for a second. So this is the monetary base and the Fed's balance sheet, which are M2 versus the Fed's balance sheet, which is not quite the monetary base. It's a little more than the monetary base because there's other stuff at the Fed, but it's close enough. So you've got is this growth? You've had this massive growth in the money supply in M2. Is that a powerful argument for persistent inflation? Bitcoin salespeople would have you believe yes. I don't think it's necessarily that simple, and certainly increase in the money supply, all else equal, over time will raise prices, but that's not the way the world works. You have velocity of money and you have GDP growth, in addition to some other factors that make that claim a little aggressive. And I showed this chart last time, so I'll just spend 1 minute on it and suggest that growth rates in the monetary base here versus growth rates in inflation seem to have almost no short-term correlation. That is, here's the regression equation. The R squared is very low. Just because you have higher growth rates in M2 or the money supply here doesn't necessarily translate. You would expect this line to be positively sloped this way if there was a strong relationship between the immediate growth in M2 and inflation. But you don't. In fact, the sign of the equation is actually wrong. So I just would say, thinking about the quantity theory of money, which gets tossed around a lot, it needs to be understood in the context of there's not all else is equal, and it takes 10 to 15 years for this equation to actually come true. So I'm not a buyer that's a big issue. So what do we got here? This is let's go to how surprised the Fed was. Actually, the Fed was pretty darn surprised by by inflation. Just in March, middle of March, they thought inflation for all of 2021 was going to be closer to 2%. But then in the June FOMC meeting, when they put their summary of economic projections out, it was up almost 100 basis points. So in 2021, just literally 4 months ago, the Fed thought inflation was going to be 2. Now they think it's going to be 3. They didn't change their 2022 and 2023 forecasts all that much. Again, this is the argument that the Fed believes that inflation, the burst in inflation, is transitory. Where do we stand? We got a print yesterday in inflation at the CPI, Consumer Price Index number, 5.4%. CPI core at 4.3. These are the highest numbers since August of 2008, or for the core since the early 1990s. The Fed cares more about the personal consumption expenditure core index, PCE core. That is in the danger zone temporarily. It was down to less than 1% a year and 3 months ago, but now it's tripled, almost quadrupled to 3.5%. The Fed is going to continue to insist that inflation is transitory. They have to, otherwise things might get out of hand. There's 2 or 3 other ways we're looking at inflation right now that I think are instructive. One is to decompose the consumer price index into what we would call transitory, or possibly transitory factors, and then the more persistent factors, and looking at wages and rents. Wages and rents as components of the CPI and other data series are persistent. Those are the things that cause what we call a wage price spiral. A wage price spiral gets embedded into the economy and must be dealt with by the Federal Reserve. So the Fed will act to reduce monetary policy accommodation if they believe inflation is persistent. But right now, most of the inflation, which I mentioned earlier, the July inflation print was 5.4%, one of the highest in the last 13, 14 years. Here are some of the components, and the components can I think, be characterized as potentially transitory. They reflect a reopening, a desire to get out and travel and go to restaurants and go to hotels, get on an airplane, et cetera. So there's a high demand for that, but the supply or the labor market hasn't really fully recouped itself yet. So there's a significant increase, and not only is the labor market not just there yet, but some of the goods markets aren't there yet. As a result, there's a lot more demand, a lot less supply because of a supply chain disruption that's transitory. So here's some of the things that are contributing to this 5.4. Car and truck rentals. This number was 100% last month or the month before, so it was a double. It cost you twice as much to rent a car in May or June of 2021 as it did in a year earlier. Gasoline, used vehicles, this is hotels. All of these 20 to 40% year-on-year increases are contributing to the 5.4. But our view at this point would be that those are reopening trade and are likely to fade as supply and demand become more equilibrated. The persistent issues that the Fed cares about is rent of a primary residence and CPI shelter and wages. This is average hourly earnings year on year. If average hourly earnings, looking at this number or the Atlanta wage Fed tracker and some other things, start to bubble up to higher levels, then the Fed's going to have to act. But right now, these are lagging, unfortunately. So we won't know for sure how rents and wages are looking for quite some time. We also look at the persistence through this, what we call these trimmed mean measures. So some are flashing red, some are in green. When you take the outliers out, it gives you a better sense of the trend. So there's just a lot of different ways to measure CPI and inflation. The Fed in Dallas and Cleveland and Atlanta do it a bunch of different ways. I'm just highlighting here that the stickier measures are the ones that cut out the outliers, like I was showing you on the prior page. Those look a little more manageable. So 2%-ish, 2.25%-ish. There are a couple, though, that would be flashing a red signal to the Fed, and those would be the U.S. market-based PCE core numbers, and in this case, the Cleveland trim mean. Hard to know. The Fed's keeping a close eye on these measures for sure. The market has an inflation expectation embedded in it too, in the Treasury inflation protected securities. So right now, 5-year break-even inflation, as the market is telling you, for the next 5 years is going to be closer to 2.6. That's in the yellow, almost red zone. Whereas longer term, the 6 to 10 year out inflation number is much lower. So again, that's a transitory thing. Right now, the market's saying, yeah, for the next couple of years, we're going to see inflation in the 2 to 2.5% range, but after that, it'll be below 2.5%. That's what the market's saying right now. So again, the most important thing for the Fed is to maintain well-anchored inflation expectations, and they're the highest they've been in 13 years. So we got to keep an eye on that. I just want to mention a couple of things about the labor market. There's still 6 million people out of work. 2 or 3 million of them aren't coming back. And that's a big issue. They're retired. They're just not, and there's a lot of skills mismatch out there as well. The labor market data that we're seeing is distorted by a bunch of these factors. And though we got a very nice non-farm payroll number of over 900,000, there was a lull here in this return to work friction that could return if the COVID variant become more of an issue. So the labor market is not quite healthy, and the reason the labor market is really important is if people can't find workers to fill the jobs that they have open, which, by the way, job openings, hard to fill. That's a series survey data. People ask business owners, is it hard to fill jobs? Half of the folks that own businesses out there say it's hard to fill jobs, whereas only a quarter did a year ago. If it's hard to fill a job, you're going to have to pay people more. So plans to raise wages increase. It has a very strong correlation with whether or not it's hard to fill a job. So these labor distortions, they might be transitory as well once the skills mismatch sorts itself out. But right now, the Fed's keeping a real strong eye on it. There's a record number of job openings. If you've got any kids out there looking for jobs like I do, having a record number of job openings is a target-rich environment, but there's not a lot of, there's a skills mismatch. People are quitting jobs at the highest rate. These are signals of labor market strength. So many jobs are being offered. So many people are voluntarily quitting, no problem. And part of it is because the labor force participation rate is very low. If the labor force participation rate recovered, the job openings would decline. People would, find where they're supposed to be and stop and not quit, and then the pressure on wages would come off. A lot of commodity prices spiked in the aftermath. This is lumber and iron ore prices, but lumber has done a round trip almost. Lumber is back to its 5-year average, and iron ore was up 300% at the peak. So these construction type commodity proxies are shown an interesting rollover, and that's the topic of the next piece here. I'll just talk for a few minutes and then open up to some questions about the peaks. And what are we seeing in peaks? We're seeing peak policy stimulus, peak global activity and growth, and peak earnings growth here in the S&P in the United States. Are we seeing peak COVID? Don't think so. Peak inflation? Probably. So if I had to put my chips down someplace, I'd say inflation is more transitory, but that depends on how you define transitory. So just a quick peek. This is monthly fiscal stimulus for the last year and a half. You were getting a couple $100 million worth of fiscal stimulus being pumped into the marketplace up until, well, last month, and the forecast going forward is pretty low. Fiscal stimulus drops off precipitously in the second half of this year. Monetary policy stimulus, this is the monthly purchases of the Federal Reserve. We expect tapering to begin at the beginning of next year. So monetary policy accommodation will not have the same precipitous fall off, but we're there. We're at peak stimulus. Stimulus won't go higher from here, even if you get an infrastructure bill, reconciliation or bipartisan, because most of the spending will be pushed out into the future, 2022, 2023. So the immediate effect is we're at peak stimulus right now. Even though we're at peaks, by the way, the effects are going to last into the future. And here's how it's going to play out in terms of global activity. You saw this chart earlier. It's the JP Morgan Global Diffusion Indices. What you see in the last couple of prints is this significant fading in momentum. So while you're still above 50, which means the global economy is in expansion mode, it's just not expanding at an accelerating rate. It's expanding at a decelerating rate, and that's true for a lot of the series that we're looking at here. So we think we're at peak global activity, and here's how it shakes out in terms of GDP. So here are the actual GDP prints for the U.S., China, the Eurozone, and Japan. The U.S. is in blue, the Eurozone is in orange, et cetera. So you still have these negative numbers during the COVID recession in 2020, with the exception of China. China was the only major economy that actually printed a positive GDP number in 2020. And the numbers are very strongly positive in 2021. But going forward, yes, strongly positive, but at a lower rate. So it's decelerating. This is the change year on year from the prior year, actual and forecast. So it's the difference between, for example, China in 2020, 2.3 to 8.5. China's up 6.2. The US went from minus 3.4 to plus 6.5. That's an increase of almost 10%. Eurozone had an even bigger recovery. Problem is the recovery, or the second derivative, you're still going to have positive GDP growth, but the changes will now be negative. So that's another way of saying the second derivative of GDP growth is now is negative, and hence it's the deceleration and a waning of the momentum. So peak activity, peak GDP growth, peak monetary policy. We talked about that in the U.S., but there's more. 2020 was the year of the rate cuts. So tons of monetary policy accommodation across all global central banks in 2020. whereas 2021, there's more rate hikes than rate cuts. And in fact, some of the emerging market countries are actually raising their interest rates. This is average global central bank rates. In emerging is orange, developed markets is in blue. We're not going to see any hikes in developed market central banks anytime soon. Just two more quick charts, and then we'll open it up to questions. Hopefully there are some. I don't see any in the chat right now. Please, here they are in the Q&A. Peak earnings per share growth. So again, this is the S&P 500 earnings per share on a quarterly basis. The numbers are positive. This is forecasted for the next 4 quarters. The numbers are all positive, but the growth rate again is rolled over pretty significantly. And the growth rate, by the time you get to sometime in the middle of towards the end of 2021 and into 2022, the growth rates are actually negative when you're comparing them from the prior quarter. The growth rates themselves will be positive. The numbers will be positive, but when comparing to the prior quarter, you won't see the same type of momentum. So again, peak activity, peak growth, peak earnings per share. What are the implications? I'll leave this for review because I've talked a lot about all of these issues in the summary of the outlook. We had the snapback recovery in the US economy, but that left us with these very high debt levels, probably higher tax rates, but certainly financial repression where we're going to have and be faced by negative real interest rates. This is the equity risk premium. It's in neutral territory. So looking at the equity market, it's hard to say it's really expensive because when you compare it to 10-year yields, which is the way to, I think, the better way to think about whether equities are rich or cheap, compare it to 10-year, the earnings yield on the S&P versus the 10-year Treasury yield, it's about at its 20-year average right now. So that doesn't tell you that equities are they're neither rich nor cheap. And it's important to note anyway, we're going to have a setback at some point. We're going to have a 10 or 15 or maybe even a 20% reversal in the equity market. Some bad news is going to be unexpected and will increase the uncertainty about corporate earnings recovery, and we'll have a downdraft. But we get a downdraft almost every year. This is 40 years of history. These are the actual largest intra-year decline. So 2008 was the big one. You had 49% decline, and the market ended up down 37% because the decline happened in October, November. Year to date, we're up about 19 or 20% on the stock market. We've only had a -4, so we're about due. And it's much more likely that we would have a reversal in the equity markets, which we can live through. If you've got the plan and it's set and your strategic allocations and your cyclical allocations are appropriate, then you can afford to ignore a 10 or 15 downdraft, especially if a 10 or 15% downdraft is expected. And I'm saying it should be expected. So we've had a lot of good news priced into this market, and a lot of the drivers of the good news for the last 17 or 18 months in terms of stimulus, that's the good news. Obviously, COVID reversal is not that great news. That could rise up and be a catalyst for a little bit of risk aversion. We should ignore it because, frankly, if you do get a reversal in risk taking, it's likely the Federal Reserve will re-up on monetary policy, and the fiscal authorities will look to add some more stimulus. They'll respond. Negative real yields in munis and bond and corporate bond markets. This is a slide I use a lot. It's just to highlight the fact that there's no escaping the tyranny of negative real yields. They're bad for savers. They make it very difficult to achieve your investment objectives, whether you're invested in municipal bonds, high yield corporate bonds, treasury bonds, of course, are the most negative. And it's because of this rise in inflation expectations that's getting you there. We made a couple of changes in the asset allocation outlook for third quarter. We're shortening up the duration of the portfolios. We've taken off the corporate credit bet because spreads have tightened so dramatically. And we're adding to our alternatives bet because in a world of negative real interest rates, it's the best way to go. So just to put a fine point on it, we've seen equities rotate and then rotate back out of large cap growth and into value, small cap. And the rotation into non-US equities just hasn't happened yet. We're less enthusiastic about credit markets now because there's been a massive recovery. So the compensation for risk in credit markets is less. Inflation protection still makes sense, and that would include precious and natural resources, although gold has been a very disappointing trade. Eventually, the dollar is going to be challenged, and some of these other rotation trades into the international developed and emerging market areas are likely to outperform. So we still like the cyclical trade, still think it's going to pay off. Hasn't yet, but that's because interest rates have come down. Once interest rates begin to normalize again and move, 10-year yields move back up closer to 2%, I think we'll see we'll get some joy from the value, small cap, and non-U.S. equity trade. A couple of questions are being posted. If you have more, please put them in there. We've got another 5 or 10 minutes or so. Happy to take all your questions. How confident are you the U.S. dollar will remain the reserve currency? Why not EU or China taking their role? The answer is it's not my confidence that matters. It's the central banks of the world, and they will continue to use U.S. dollars in their currency reserves to stabilize their currencies, because the U.S. dollar and U.S. dollar markets are the deepest, safest, most liquid and tradable markets in the world, and there's nothing to challenge that. It won't last forever, probably. It never has. The Dutch guilder, Spanish peseta, British pound just immediately preceding the US were all reserve currencies, and they aren't anymore. But as we showed in that one chart, 60% of the reserves that are out there are denominated in US dollars, and the next closest challenger is the EU. And the ECB doesn't really have aspirations to become a reserve currency. At that 20%, and at 2% or 2.5% now of assets, the Chinese don't have it. They don't have the liquid, not yet. They may be moving with all due haste towards the potential to become the reserve currency, but it's going to be decades before they're going to get there. Why is labor market participation so low? It's about 60%, where it usually is 62%. The answer is because labor force participation is the percent of the workforce that's actually working that wants a job. So there's a lot of folks out there that don't want jobs anymore, and the retirees, and frankly, the folks that are waiting for unemployment benefits to roll off and school to start. So I suspect there'll be a spike. There's also another thesis that was tossed out by a senior member of the PIMCO investment committee during our conversation yesterday, actually, that suggests that there might be an increase in labor force participation because of the work from home. There's a lot of folks out there, call them moms and dads that take care of kids at home, that now can have a job outside the house as well, because they have more flexibility with work. So labor force participation might actually increase. That would take a lot of the pressure off wages and make the Fed's job easier. Stephen asks, the emerging market story has been that they will grow faster with new COVID than the developed world. With new COVID and China policy, is that still true? Yes, eventually, because GDP growth is, using a Cobb-Douglas production function, is partly and largely determined by demographics, technological innovation, and capital deepening. So I'll tell you where the emerging markets have a significant advantage over us, and that is labor force growth. So if GDP is equal to labor force growth plus productivity growth, and it is, then the demographics of EM continue to dominate the demographics of developed. But the question is, will there be hiccups on the way? And there always is. I mean, you get something like the COVID issue, and the infrastructure in emerging markets isn't capable of doing what the U.S. can do and other developed markets can do in terms of getting back on track. So I call it's recovery delayed, not recovery eliminated. Is there a comparison to U.S. versus international growth? International growth is done better than international value, for sure. I don't have the numbers for U.S. growth versus international value or international growth, but the answer is going to be U.S. growth is going to dominate, because in terms of performance, because it's concentrated, we are the tech capital, and a lot of the industries or the industries that make up most of the IFA and other indices outside the U.S. just don't have the same tech component. So if you just look apples to apples, growth to growth, it's really the U.S. that's been dominating. So if you do believe interest rates are going to go lower from here or stay low, then you should stay in the growth trade. If you think interest rates are going to maybe rise a little bit, then maybe it would be time to move into some of these rotation trades. Okay, I got 1 or 2 more minutes, and then I'm going to close it up here. We've got a couple more questions. I'll get to all your questions. If I don't answer them live, I'll answer them I'll post them somewhere. We'll work with Sarah in our group to get that done. What should we do with a bond portfolio with negative real rates? Reduce your exposure to negative real rates, because they're purchasing power destructive, by buying something that either has positive real yield, or look for risk premiums that are outside the public markets, which is another way of saying you should probably looking at alternative sources of income like private credit and private real estate, which also has the benefit of inflation protection. I would assume this would not be, let's see. Aren't growth rates guaranteed to be lower after such a rapid increase in growth after COVID vaccines? So Dwayne says, yeah, the answer is growth rates are not guaranteed to be lower just because of a exogenous shock like COVID, or the fact that we've had a large run up. Growth rates in the GDP are, function of things like productivity enhancements too. Growth rates in EPS are likely, and growth rates in performance, yes, all else equal, given the run up we've had in equity markets, the future expected returns for equities are much lower because you're starting at a much higher starting point. So that is true. Would you consider crypto to be a possible contender for reserve currency in the medium term? Absolutely not. It's not a store of value yet. It's too volatile to be a store of value. What are your, looks like, okay, gold has been disappointing. Yes, it has been. It's been disappointing because it hasn't acted like it was supposed to, in large part, I think, because of the transitory nature of Bitcoin demand. I'm not so sure, and I don't want to talk about Bitcoin in particular, but cryptocurrencies, I don't see an intrinsic value to them. So it's hard for me to say they're rich, cheap, or fair. The technology, blockchain is absolutely outstanding and will dominate the world at some point. It doesn't mean Bitcoin is going to replace gold. It wants to, and it may. And that's part of the reason why gold has done, I think, poorly. Gold should do much better in an environment where you have such negative real interest rates, but it hasn't. And sometimes you just have to look at it and say the market's smarter than you, and maybe modify the trade, either take some risk off or take the trade off altogether. Should we continue with gold? I hope the answer is yes so far, but that can change at the next quarterly macro and asset allocation meeting. Are foreign developed countries' outperformance tied to their pandemic actions or ineffectiveness? Their underperformance is really tied to corporate profits. They're partly to the pandemic ineffectiveness in the emerging markets for sure. Some of the other markets, it's tied to the industry composition of the IFA versus the US. I mentioned that before. We have a lot of really best-in-class companies here in the US, and they're getting fully valued, whereas other companies that also have very strong economic potential aren't. I'm gonna one more question on real assets and real estate and transitory. I'll try to weave that into a couple final thoughts. Real assets are good in an inflationary environment. We think inflation is going to run hot. Real estate looks particularly good in some areas, particularly subsectors, industrial, multifamily, not necessarily corporate, commercial A space in gateway cities, but real estate, generally speaking, should be in everybody's portfolio for both growth and income. And transitory means whether or not inflation is going to last long enough for the Fed. That's the real definition of transitory versus persistent. If it's persistent means it hangs around long enough for the Fed to have to do something about it, and that would cause risk taking to take a hit. But if we think about things in the longer run and focus on the cyclical repression theme, try to get things right in the shorter run with our secular financial repression theme, try to get things right in cyclical terms by looking at inflation rates and rotation, and in conjunction with your financial advisor and the consultants, we'll position the portfolio the way we think is likely to do the best job of meeting your investment objectives. I want to thank everybody for joining the quarterly macro and markets call today. We appreciate your interest in Beacon Pointe as a client, as a prospective client. That's the end of the call. Thank you very much for your attention. Look forward to being with you again very soon.